rolling this for the sake of time here. Thanks for everybody for showing up to tonight's JUMPinar. This is our twice a month training program series that we have in addition to our official training program, which happens a couple times a year. But we meet here on Wednesday nights to talk about special topics in real estate and really dive into some of those more nuanced conversations that we can't necessarily host during our regular training program. And we like to make these open to the public and, get some great questions from all you guys and have a chance for you to interact with great speakers like tonight's. And tonight's topic, we're talking about the refinancing process for, an aspiring real estate developer. This is more, focused for people who have a buy and hold project in their future, as opposed to buying and selling a property. But, you don't never want to close your doors on what your extra strategy might be one day. And it's an important topic to really understand the fundamentals of. So I'm happy that we're having somebody from Philadelphia Federal Credit Union here tonight. His name's Dale Adair, and he is a business loan manager with them. You've probably seen that name PFCU around quite a bit, and I'm excited for Dale to tell us more about it. Before we jump into the session tonight, I just wanted to give a few housekeeping things. The first is our hard money loan, Jumpstart Philly, is open and accepting loan applications, and we're funding projects every week. So I encourage you to go to our website at jumpstartphilly.com and check out the loans page there, and feel free to reach out if you have any questions. Also, our training program, the Jumpstart Germantown training program, is also accepting applications for our upcoming training program this fall. It starts on September 26th and will be every Tuesday and Thursday evening for that next month. And it's a really great opportunity if you're brand new to this. And, Sarah will put the links in the chats for both our loan program and our training program, where you can check out a lot more information. And the last thing is we have a Q&A tab tonight. So we won't have the chat open for everybody, but rather you'll enter your questions into the Q&A tab, and I'll, we'll sort through those as we go and hold a majority of them towards the end of our discussion, so we make sure we cover everything what we want to. So with that, I'm going to introduce our guest. His name is Dale Adair, and he is again from Philadelphia Federal Credit Union. And I'll give him a chance here to just say hi, and then we'll jump into tonight's topic. How's it going, Dale?
All right, Derek. Thank you very much.
Of course, yeah.
Thank you for having me on here. This is a great program you have going on here, and I'm glad to be a part of it.
Thanks. Yeah, thanks for coming.
So,
why don't you start with just telling us a little bit about PFCU and what you do with them?
Sure. I'm the business lending manager at PFCU. I've been here for 12 years, but I've got about 40 years lending experience, commercial lending experience, with mostly community banks, some regional banks on both sides of the bridge. Like I said, I've been with the credit union for 11 years. The credit union approach to lending is much different than traditional bank lending.
Mm-hmm.
When you're a member of the credit union, there's lots of things that are available to you that you wouldn't get at usual banks. And we usually try to, work with the prospective members and borrowers as much as we can.
Mm-hmm.
The credit union was established as a credit union for the city of Philadelphia employees. And then the charter expanded so that to become a member and for us to be able to lend to you, to lend to you, basically, here we are, you would have to live, work, worship, or do business in Philadelphia. So anybody that's got a property in Philadelphia, they live in Philadelphia, you could have a property outside, doesn't matter, whatever that connection is, we can help you.
Great.
So a lot of the things that PFCU does is CRE lending. It's probably 98% of what our business portfolio does, and we're pretty good at it. Very diversified, anything from single family, multifamily, mixed use, commercial, industrial, we can take a look at for you.
Gotcha. Great. So, and by CRE, you mean commercial real estate, but you're considering even a single family residential home that someone's buying for an investment purpose. That's commercial real estate, right?
Yeah, that is, as long as it's an investment producing property, then that comes under the other CRE umbrella.
Okay, great. So let's jump into like what the topic is tonight, and that term refinancing comes up a lot when we're talking about real estate deals. Why don't you, for somebody who's heard that term but doesn't know what it means and is looking to get interested in real estate, how do you define refinancing, and what is that what's the significance of it for a real estate developer?
So as we approach refinancing, you could buy a property free and clear, all cash, do all your investment improvements to it. But when you get a mortgage on it, we still consider that refinancing.
Mhm.
Obviously, refinancing is when there's an existing mortgage on the property and you're going to pay that off, right? With a new loan. And usually, what we're talking about here is your construction loans or something like that, where we put it into permanent financing if you are thinking about holding the property due to a rental income.
Okay. And how does this process benefit a developer? Like, what is the incentives of refinancing as opposed to either saving up enough money to pay off the loan, which is very difficult, or or just keeping with the first lender, right? Is there some incentive for developers to do this?
Well, most construction loans and that we work with, they're providing money to acquire and improve the property, but at some point they want to get out. Right. So, they're giving you the money to acquire, improve the loan. And then they say, okay, we want to get off. We want to get out. They want to turn their loans over.
Yep.
And that's where we come in. We're more the permanent financing end of it. So that once you've acquired, renovated, and have a property under lease and it's producing income, that's where we come in.
Gotcha. So it's that distinction between short-term and long-term. You semi or construction financing versus permanent financing. You're basically escaping the first situation with either a longer or a lower cost solution, right?
Yeah, most of the construction loans are pretty much interest only at a much higher interest rate, right?
Right.
So at some point in time, you have to start repaying that loan.
Yeah. Totally. And the first part of that, I guess, is repaying the first loan, which in some cases could be a jumpstart loan, where there's this huge sum of money that is due at a single point in time. And a lot of people, no matter how good the deal is, don't have the capability to just pay that out of pocket, right? So they come to someone like you for refinancing. Gotcha.
Yep.
So is there any other, before we move on, any other benefits you can think about refinancing? I know lower interest rate is one. Obviously.
Yeah, absolutely. So, most hardly money lenders, I don't know where Jumpstart is, but most of that we see are pretty much interest only, and they're 11 to 14%.
So we're at 9.71.
Wow, you guys are pretty good then.
That's right. That's right.
I can make some referrals to you.
I had to make sure I got that plug in right before you moved on.
Very good. Very good.
Yeah, so we're at 9.7, but a refinance loan would be even lower than that.
Yeah, so right now we tie all our rates to the 5-year treasury rate and plus a certain margin. So now if you were looking to refinance a loan for a permanent mortgage, we're probably at the 6.5 range. Okay. Unfortunately, the way rates are now, they're changing every day. But generally speaking, that's 6.5.
Okay. So I'll ask more questions about that later. But while we're on the kind of defining topic, could you set up a scenario, like not every real estate development project, especially if you're selling it and not holding the property, is going to need to refinance, right? So what's the scenario where someone almost is required to go through the refinancing process? More so, can you just explain the steps of like a buy and hold deal, right? How you're using one loan for construction and then going towards the refinance loan. Like, what does that look like for a new developer?
So most of the developers that we work with, hopefully they're buying at the right price. They're doing the improvements at the right price. And at the end, the appraised value is going to cover their investment
Mhm.
and maybe give them some more additional money,
Mhm.
obviously to cover closing costs,
Mhm.
and maybe for some more additional money for future real estate investments.
Mhm. Mhm.
So, we see a lot of times, I'm just gonna throw out numbers, but you put in 200
Mhm.
acquisition and renovations, and the property comes out to 280 or something like that, based on the percentage that we can lend on, you're going to pay off the existing loan and maybe come out of pocket with some money.
Mhm.
That's how we can continue to build relationships with our real estate investors, that they take that money and invest it in future real estate investments.
Gotcha. And it seems to be a little bit more complicated, or not complicated, but more complex than a buy and sell deal, right? Where you're selling the property for a profit that is higher than the costs you put in. You don't have to worry about long-term debt coverage, right? Or any,
No,
operating.
no. If you're buying and flipping, you're taking your profit and
Right.
head into the
Yeah.
restaurant.
Yeah, right. So we're talking about buy and hold projects, and jumpstart. A lot of jumpstart projects are buy and hold projects, and that's a very common way of amassing a portfolio, and right, having several single family houses. So you're probably going to be doing this refinancing piece a lot. If you're getting several like smaller hard money loans, what like signifies it for a developer to know when they're ready to get a refinance? Is it the day construction completes? Is it, after they've been paying their hard money loan off a little bit? Is it before construction starts? So, when does this issue come up for a real estate developer?
All right. So for PFCU,
Mhm.
we require that anytime that you want to get permanent financing, you have to have a lease in place. The property has to be generating income at the time of application,
And
right?
would you say that's commonplace for other
I
banks?
would say that's very commonplace,
Okay.
right? Unless you personally have a really strong income stream that you can say, I can cover whatever the loan payments are until I get it rent out, but we don't see that too often.
And that's why they're looking for the lease, right? To make sure that you're making the money that's going to pay off that loan.
That's right, because worst case scenario, and that's the banker in me, please. If we, when we do a loan, we get what we call an assignment of rents,
Mhm.
right? So if the loan goes south and you don't pay us, we can go to the tenant and say, you pay that rental income to us now. And that keeps the loan current. Right. So that's a big factor.
Okay. So, I mean, obviously to have a lease for your property, you need to have the construction completed, right?
Yep.
Is there any other sort of like characteristics that need to be in place of the property for you to be able to get this? Is there like
Not really. I mean, if it's your first time to the dance, so to speak, and you don't have any other investment properties,
Mhm.
most banks will, and PFCU will require what they call a seasoning
Mhm.
period. A
Mhm.
seasoning period is that you can show from 3 to 6 months that you've been getting on-time payments from your current tenant,
Mhm.
right? So they want to make sure that, everything's going, we've got some income established, and then we can take a look at the permanent financing.
Okay, so if the permanent lender does require that, do you have any other options other than like, could you maybe accept less favorable terms to get that refinance started sooner, or do you have to kind of just sit it out and to get that like?
Well, as far as PFCU is concerned, and I would probably say it's pretty common, if it's not generating income, you're going to have a hard time getting permanent financing.
Gotcha. So that's why that seasoning comes into place, where you just
Yep.
so you basically in a situation where you're using a hard money short-term lender, right? If you start renting out that property 3 months before the hard money loans due, right? You're then you can refinance before the first loan is up, right?
Yep. Yep.
Gotcha. So just thinking out strategies here, because
Yeah, yeah, yeah.
some people might get to the 364th day of their hard money loan and be like, oh, well, now I have to, pay this permanent bank or these extension fees without any, getting my loan.
Well, unfortunately, Derek, that's what we generally see.
Right. Right.
Most new players to the table don't
Mhm.
already have a lease in place before construction's done,
Right.
because who's going to rent
Yeah.
a place that they can't walk through that's not completed,
Sure.
right?
So it's really important, I guess, for jump starters to keep in mind the timing of when their loan is coming due versus when they're going to be able to refinance, especially if they have to season their company, right? Yeah, that's all great insight. So why don't we talk about what I'm sure most of the questions we've gotten in chat are so far, that what are the terms and rates that jump starters can expect for a refinance loan? Just to give context, a jumpstart loan is 12 months and our rates are 9.71. We're interest only, monthly interest payments after construction is complete. What does a refinance loan look like in comparison to that?
Okay, so what PFCU does is that we provide permanent financing. They are generally 5-year fixed rates, right? So currently we're around 6.5%. At the end of 5 years, whatever the 5-year treasury rate is, plus that spread that we agree upon, that becomes your new rate for the next 5 years. And then it does it one more time from years 10 to 15. It will actually mature or balloon, which means all payment, principal, and interest is due at the 15th year. However, your payments can be based on a 20 or 25-year amortization. So one of the advantages of the credit unions are they're just adjustable rate mortgages. A lot of banks that you will work with, they have a 5-year rate, and at the end of 5 years, it's a hard balloon or maturity. So, if you put a loan on for $250,000 and you paid it down 5 years, you're probably still at $238,000. A lot of places go, all right, that whole loan amount is due. So we have to renegotiate, reappraisal, do all that stuff. With PFCU, the rate just adjusts. So you don't have that hard maturity. So you could always go, all right, well, you got 3 options. That rate's great. I'm fine with that for another 5 years. You would call up and go, hey, I've been paying my loan on time. What can you do for me if you think it's a little bit high? Or you can just go, I'm going to go someplace else. But there's no banging on the door saying, I need you to pay $233,000 because it's ballooned. Gotcha. Right? So the credit unions, they have a 15-year maturity. So I don't think I've seen too many actual loans get to 15-year maturities because appreciation, rates have changed. People, they all refinance before the 15-year maturity.
Sure. Yeah. And comparing that 15-year loan term with a permanent bank or a traditional bank, I've heard like a 30-year mortgage is more a 25-year term. Is a credit union like distinctly shorter than those, or is there any reason for that?
The maximum that the credit union will go on an amortization basis is 25 years.
Okay.
That's Philadelphia Federal Credit Union.
Right.
And if we went 25 years, the loan to value that we lend on would have to be 75% or less of the appraised value.
Yeah. Gotcha.
You can get up to 80% of the appraised value, but if you do that, we keep it on a shorter leash, and it's only a 20-year amortization. So, most investors have to think, what do I want? Do I want the cash flow out of the property, or do I want to build equity in the property very quickly?
Gotcha. And that decision will factor into which loan option you choose, right? Whether you choose the longer term, shorter term.
Right.
Gotcha. Okay. Gotcha.
Right.
That's interesting. I've never thought about it that way, where it's like one way you're building cash flow now in the short term, the other way you're maybe not making as much money right now, but you're paying off that loan quicker, right?
Yeah. Right.
Gotcha.
Right. So, and you always think first, very important for the investors is that, oh, my place is worth 300,000. Don't base on the loan to value as what you want. You have to base on first what the cash flow
Mhm.
of the property is, right? Because the credit union or any bank doesn't want to own your property, right?
Right.
Our thing is we want our money back, right?
Yeah.
So we always look to the cash flow of the property first to be able to service the debt that you're looking for,
Mhm.
more so than you could tell me. I mean, in this day of fluctuating rates and stuff like that, but we have some people that come in and I've had a long time tenant. They pay great. Their rent is below market. I understand, but that's what I'm happy with the fact that they're a consistent, solid source of repayment.
Mhm.
But if that doesn't equal the cash flow for what the property may be worth, then most lenders will go, no, I can only lend on this.
Yep. Great. And in a minute, I'm going to ask you a question about sort of what are your like approval thresholds? What are those ratios, percentages that you look for? But before we get to that, I just want to make sure jump starters know how they can determine what rates they're eligible for. Like, is there a web page that they go to where they read through their terms that are general for everybody, or should they get on the phone and talk to somebody? Should they come down to the credit union itself? What would you recommend people do to determine what rate they're going to get for their project, or what the terms will be?
Well, business lending is nothing like consumer lending, right? So business lending is based on risk,
Mhm.
credit quality, loan to value, many other things that go involved in the decision process.
Right.
So you can't go and just go, oh, this is what I'm going to get, right? You can't go, oh, my credit score is 658 and it gets me this rate. My credit score is 700, it gets me this rate, right? It's all about the ability to repay. So, like I said, our rates are, you would call and go, where are your commercial rates at? We'll tell you, generally speaking now, 6.5%. Then you decide, whether you want to move forward on it.
Okay, gotcha. Yeah, I think that's important for people to know, especially like the earlier they start thinking about it and the earlier they build their credit, talk to some permanent lenders, the earlier they figure these things out, the better guess they're going to have, right? They can't just, type it into an equation and it gives them rates and stuff. That's good advice. So the next question I want to ask you about these terms and rates is, what is the flexibility, I guess, from the borrower's standpoint of negotiating these rates? Is this something they should come into and think that they're going to prove their case for to get a lower rate, or is it, what you offer is what they get kind of situation?
Well, negotiating is a skill.
Yeah, right. That's right. It is.
So, if you have strong cash flow, great credit history, experience, if you have a lot of, small, low loan to value, these are different factors that you take into consideration, right? I will say, for most first-time investors, a lot of those equations are off the table, right? Because you don't have any history of doing these type of projects. You don't have any history of really repayment, that type of thing. But credit score, obviously, right? And
So,
cash flow, credit score, cash flow, predominant.
Does PFCU have a minimum credit score?
We do not, but you cannot have anything that has been delinquent recently in payments, I would say within the last 6 months.
So you're looking at the credit history more so than the credit score itself. Yeah.
Yep.
We take a similar approach, for a buy. I guess we're on the assumption this is true for PFCU, right? But for a permanent bank there, or a traditional bank, sorry, they may be looking for a specific, we've heard 680 is the minimum score. Is that something you're familiar with? Yeah.
It depends on why it's a 680,
Gotcha.
you
Gotcha.
know?
Yeah,
I mean, you could have a low credit score because you've had a lot of people inquiring about you,
right.
right?
Right.
There's different reasons why it gets to that magical FICO score,
Yeah.
right?
Yeah, sure. Sure.
But the most important part of that score that we look at is
Okay.
payment history and the level of debt that you have.
Okay. And you mentioned cash flow, and let's talk about that acronym that we use a lot talking about Jumpstart is DCR or DSCR, debt service coverage ratio.
Yep.
I've explained this to people a lot, and I feel like I still somehow confuse them. But why don't you take a stab at explaining that ratio to us and kind of highlighting why it's important for a deal like this?
Okay. So I'll kind of target to the audience.
Yeah.
But so, if this is a first time property that has no history of income, right? So you've just finished the renovation, you've got it under lease. So how we approach it is we will take your gross rents, we take 5% vacancy factor, right? Subtract that, and we get to what you call an effective gross income, right? Then we subtract your actual real estate taxes and insurance expenses. And then we add on 5% of the EGI number for repairs and maintenance and management fees. If we want to get real conservative and we see that, there's utilities involved, we may take another % or two.
Okay.
That gets us to our total expenses. That gets us to what we call the NOI, the net operating income from the property. And then we take that versus the loan payments that you're requesting. And generally we require a 1.25 debt service coverage requirement. All right. That means for every dollar that you owe on the loan, we look for $1.25 of income, right? Just to give it a little leeway, right? One, because if you have a vacancy, of course, right? Somebody skips a payment. Lord knows we just got through COVID. I can't tell you how much about all that, right? So you never know what's coming down the pipe. But that's kind of our formula that we do it. So gross rents, vacancy 5%, EGI, then we take actual real estate and insurance expenses and 5% for maintenance and 5% for repairs and maintenance to get to our NOI to see how it could service the loan.
Great. Yeah, that was effective. That was great. I think, and then just highlighting from the investor's perspective, right? It's one of those, you were saying there's the effective gross income versus the fixed payment that you're making to the bank. One of those is fixed and one of those is variable. And hopefully over time, right, your bank payment stays the same, but your expenses are going to go down as make more in rent, right? Or you
well, so it's a rate that's fixed for 5 years.
5 years.
So most leases that we see are a year lease, right? And if you have a longer term lease, that's more favorable from a lender's aspect, right? Because then, you've got somebody that they say that's locked in for 2 years instead of 1 or something like that, right?
And they view that as more favorable as possibly like switching tenants and making another $50 on rent or something, right?
Right. Because we have no idea
that's a chance. Yeah.
Right.
If it works with the previous rent, you prefer to see that consistently. I got
you.
So
that's the variable factor. We're lending on what you're getting rent now.
Okay.
If it increases, good for you. You know what I mean?
Gotcha. Yeah.
But yeah.
Okay, and for the follow-up email that I send out to people, I might ask you to give me those expenses again that you factor in,
Sure. I'll send a little thing. Yep.
Yeah, I think that's super helpful, especially, for people who might have several projects going on at once. It's like each project could have a very different number, and it helps you analyze which are better and worse or how you could fix them. So I think it's good practice, right, to estimate all those things, not just because the bank's asking for it, but as an investor, you need to know what your bottom line is.
Yeah, and I mean, I think we're pretty conservative, but I think that's the general rule of how most places would approach it.
Gotcha.
Some may be a little bit, more conservative.
Okay.
But
okay. Gotcha. So the next thing I wanted to ask about was, and then soon we'll move here into the questions because I see we have a bunch piling up. I want to ask about the appraisal process, and how determining the after rehab value of your project works. Does the refinancer, do they choose the appraiser? Do you choose the appraiser? Is there a standardized process for that? Tell me a little bit about how it is both at PFCU and for a standard bank or traditional bank.
I would think industry wise, the appraisal process is that we hire an independent third party. Mm-hmm. Right. Mm-hmm. And they would go out and appraise the property. With PFCU, you wouldn't have to pay for an appraisal. Well, with PFCU, you apply, we do the underwriting. If you're approved, then we start the appraisal process. Mm-hmm. And it's going to be based on whatever your estimated value is and what we agree to approve. Do we going to approve 80%, or we're going to approve 75%?
So the appraisal comes at some time after you've already applied, been approved, and go through.
Right. So yeah. So there's really no cost to PFCU until you have an approval. We have no application fees. We would send you an approval notification and then let you know here's the next step. Right. So if approved, we would order the appraisal. Appraiser comes out. He is, once again, independent of PFCU. He gives us the valuation, sends that to us, and depending on what his evaluation is and our approval, 80%, 75%, whatever it is, as long as it's within that approval loan to value ratio, then we're good to go as far as moving forward to closing. So but do not order your own appraisals. Okay. Because banks won't accept them because it's not independent.
Okay.
Right?
So I think that's an important point to make. I mean, couldn't you think of a scenario where someone would want to appraise their house, without bringing it to a lender, or what's the main purpose for an independent appraisal other than to bring it to a lender?
Well, I mean, when you do a loan, right, and you're doing a construction loan, you have an idea of what it should appraise at the end.
Gotcha.
Right. Mm-hmm. Lord knows, based upon market and all the whole bunch of different factors, hopefully it gets to that number. Mm-hmm. But we've seen a lot of times it may be more or less. Mm-hmm. You just don't know. Mm-hmm. So there's generally not any pre-ordering of appraisals.
Gotcha.
Prior to you getting approval, because in our view, if you don't qualify from a cash flow aspect or anything like that, then you've spent money on something that we can't do.
That makes sense. Yeah, that makes sense. So, and you mentioned that or from what you described, it sort of sounds like the appraisal is one of those last steps where it's like, as long as everything lines up in the picture up until the appraisal, then you're good to go. It seems like that's the last approval phase. Yes.
Yes. With PFCU, you'll apply, we'll do the underwriting. Hopefully we get to an approval. We would send you an approval notification of all your terms and conditions. Mm-hmm. We ask you to either, agree to them. It's kind of like what they call a commitment letter, right? Mm-hmm. And then at that point, we go, okay, we're going to order the appraisal. When we order the appraisal, We tell the borrowers, get your title
Mhm.
going, right? Especially if you have a construction loan and stuff like that, make sure you tell the title company to keep your title open,
Mhm.
because then when we have to do the permanent financing, that
Mhm.
title company only has to go back to whenever the last search was.
Right.
And it's a big cost savings.
Yep.
Right.
Yeah, I've heard that a lot. Keep it open. Yep.
Yep. And then the only other thing we would need before closing, once we get the appraisal, is evidence of insurance naming the credit union as the first mortgagee and stuff like that.
All right. Great.
So once we get the appraisal and we've confirmed that the value is within the approval standards,
Mhm.
it's generally 3 days till we can get to closing,
Mhm.
considering that we have title and insurance in place.
Okay, great. The last question I'm going to ask before we move into the live attendee questions is about cashing out, and what a cashed out refinance means. So I think you alluded to it earlier in the discussion where we were talking about, say your property appraises for 280, but your project costs were, or sorry, your new loan is for 280, but your project costs were 200. There's a certain amount on top there where you get to decide what to do with, and might, it might be leaving equity in or taking it out. So talk to us about what that cash out means, and where a jump starter would make that decision to take money out from their project.
Absolutely. So a lot of banks frown upon cash out.
Mm-hmm.
They want you to basically pay yourself back and cover your closing costs, and that's it.
Mm-hmm.
Right? PFCU, we're not afraid of you cashing out.
Mm-hmm.
For us, that's been a great opportunity for us to grow our portfolio,
Mm-hmm.
because we have people that do this on a consistent basis. And even though prices are up and everything now, but they used to be able to take the cash out and apply it to other future real estate investments.
Mm-hmm.
So as far as PFCU is concerned, as long as everything else is in line, we're not concerned about you cashing out. You can cash out to the 75, 80% of the appraised value, and hopefully we'll reinvest and come back to us for some more financing.
There you go. That's the idea. All right, great. That sounds
PFCU pitch.
That's great. And I just wanted to mention, Sarah has put the PFCU website in the chat, as well as Dale's email, which I'll send out all in a follow-up email as well. But just wanted to make sure people have your contacts so they can reach out for direct questions. And
Right.
so that is everything I had on my my notes here, and I'm going to swap over to the Zoom Q&A. Dale, thank you so much for that. That covered all the questions I had, and
Thank you for
Yeah.
inviting me. I really appreciate it.
Of course, yeah, great info, and I'm glad we're we're recording this, so this will be up on the website for people to see, including all these great questions we have from listeners here. The first one here is from Lashida, and she's wondering, what is the minimum funding amount? So I guess to translate her question for you, what is the smallest loan PFCU would approve if there is one?
Yeah, we don't. I would say for permanent financing, it's probably 100,000.
Okay, gotcha. Our next question here comes from Stefan, and they were asking, what's the highest loan to value that you offer when it comes to loans? So I know you mentioned 75% was the standard for the 15-year.
75% is the standard to get a 25-year amortization.
Gotcha.
The max that we will lend on an appraised value on a property that's been renovated, rehabbed, is 80%.
Okay.
At 80%, the amortization is reduced to 20 years.
Gotcha. And there's no situation where you would go higher than that, right?
Nope.
Okay, but there is lower than 75. It could go lower, right? Depending on how.
Oh, absolutely.
Okay.
Yeah.
The lower
That's only more favorable for your loan request.
Gotcha. Our next question here comes from Hans, and he asks, is PFCU LLC friendly? I sure hope so. Yeah.
Absolutely. It doesn't matter to us if you own it individually or an LLC. We see a lot of people form LLCs to own specific pieces of real estate. mostly from a liability aspect,
Mhm.
but it does not matter to us.
Gotcha. Our next question, we sort of touched on this earlier, but maybe Barry's question will expand upon it. Refinancing property based on the current supply chain options will run you into a difficult situation in order to be able to rent a property before you can potentially refinancing it. So I guess that's what we're talking about. There's before your short-term loan is up, you're not able to get the property rented and apply for that refinance. What would a lender like PFCU, suggest other than waiting it out and getting that seasoning taken care of?
Well, what we would suggest to them is to work with Jumpstart
Yeah.
and make sure that they get
There you
on
go.
top of the project.
Yep.
And there's nothing too much to do there other than you really, if you got it close, market it, try to get somebody to commit as soon as possible.
Great. Yeah. I think and reaching out to potential refinancers like you as soon as possible, right? To just kind of get an idea, get involved in their,
Right.
application. So I think getting the refinancing process started as early as possible, even if that doesn't mean applying for a refinance loan, it just means starting to research it and be aware of it.
Yeah, I mean, you could talk about it that, once again, in fluctuating rate environment that we're at, I mean, hopefully everything stays the same, but really, before you start really thinking about applying for permanent financing,
Mhm.
you should be very close to the end of the project.
Yep.
And you should pretty much have somebody that is going to sign a lease for you.
Right. Yep. And
Because we really can't do anything. We've had plenty of times where we had people, I'm going to rent this place for $1,700 a month. This is why we don't do pre-approvals anymore. I'm going to rent this place for $1,700 a month, and you do the underwriting, and then they go, "Oh, I couldn't get it done for $1,700. I could only get $1,550."
Mhm.
Well,
the deal
it
doesn't
changed.
work that way. Yeah.
Yeah, it doesn't work. Right.
Gotcha. So, and I think your tip to, come back to Jumpstart and that's
Yep.
we're able to, I mean, our whole goal is to get you to finish by that 12-month term and allow you to be able to refinance. And we do that by, coming out, inspecting your property and funding draw requests and, giving you resources and tips along the way. So definitely it's a great answer that you gave, Dale, is get on Jumpstart to get you to finish your project faster.
Well, I tell you, I've read about you guys. I've checked you guys out, but for all your investors, the Jumpstart program is so valuable because it gives people input and expertise to figure, hey, I thought drywall would only cost me blah, 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 blah. Right. And then all of a sudden you go, oh man, I didn't know that. Right.
Right. Yes. There's a lot of back and forth we do with people about, I thought this thing, but there's a lot of evidence that supports the opposite. and also we're learning things, like we definitely want to give that opportunity to people to prove their case if it's there. But you're right. It's a lot of checks and balances of got to
your services are very valuable.
Great.
And as a lender too, when we see that it's coming through a program like this, it also has a little bit more of a favorable aspect.
That's great to know. Great to know. Our next question comes from Keith. How's it going, Keith? He says, in lieu of seasoning, can you show 3 to 6 months of cash reserves in your PFCU account?
Absolutely.
Gotcha.
That's another alternative. We would say, okay, you don't have the seasoning, but give me 6 months worth of your rental payments and put it into an account, and we'll just put a freeze on it. And after the 6 months, if everything goes well, we just release it.
Gotcha.
Good point.
Yeah. And next question here is from Brenda, and she says, what is the PFCU DCR rate for a refinance loan? And you mentioned it earlier, but 1.25, right?
Right. Yeah. Our minimum is 1.2, but we generally stretch for the 1.25.
Got it. The next question comes from Faye, and she said, how many commercial loans can I get under my personal name?
Well, with PFCU, it's unlimited.
Okay.
I mean, our legal lending limit is 25 million if you're going to get there anytime.
That's a lot of single family row homes in Philly, right?
Yeah. I mean, with Fannie Mae, I think with some of the other ones, they kind of limit you to around 10.
Okay.
But there's, I'm pitching PFCU here, but there are other programs out there if they're looking for long-term fixed rates.
Okay.
I mean, everybody likes that comfort knowing that my rate's not going to adjust in 5 years, right?
So
it may be higher than what you're going to get for 5 years,
yeah.
but there's other stuff out there.
I see what you mean. So again, like what you're saying is not many of those loans reach that 15-year term, right?
No.
So gotcha. That makes sense. Thanks, Faye. The next question here comes from Karima, and they said you have to join the credit union first to apply for a loan.
No.
Okay.
No, if you were approved, that would be one of the conditions of us being able to lend to you, that you would have to open up an account after your approval.
Gotcha. So, but they can start the loan application process before you kind of do it along. Great.
Yep.
Next question again comes from Keith, and he says, is there a max number of relationships an investor can have, or relationships or products an investor can have with PFCU? We just answered that actually, which is no, there's no loan amount, right?
No. I mean, we have investors, like I said, that they form a new LLC for every project that they get going on. So under one person, we could have 20 different relationships. Yeah.
Gotcha. Our next question here, I'm just there's quite a bit, so I'm trying to just
That's okay. That's good. I like that.
Yeah. I knew there would be on this topic. The next question here comes from Thembecca, and she says, will the hard money loan affect your debt to credit or debt to coverage ratio when wanting to refinance? So maybe I guess she's asking, does the size of the hard money loan with Jumpstart say influence the refinance loan? Does that make sense?
No, as long as we can pay it off. I mean, unfortunately, I have seen some hard money loans that have exceeded what they could qualify for from a permanent financing aspect. That means that somebody's going to have to come out cash out of the pocket. But generally speaking, we find that the permanent financing is enough to pay off the hard money loan.
And I think like a scenario I can imagine with the Jumpstart loan would be that the extension fees and the additional draw inspection fees and whatever out-of-pocket costs for construction, they get so high where your loan amount might actually be more to repay back than it was 12 months ago when you started the project. It's
well, that's why you have to stay on top of the project and avoid all those extension fees.
That's right.
Right.
Definitely. Our next question here comes from Sabra, and she said, are there any PPP and or origination fees? Do you know what PPP means?
No, I don't know what PPP is. Our general loan origination fee is 1% of the loan amount. Okay,
gotcha. Sabra, maybe if you want to clarify and submit another question, I can get that answered. Our next question comes here from an anonymous attendee. So somebody says they own 3 rentals. Their score is over 700, and they're in the early stages of refinancing out of a hard money loan with PFCU. An appraiser has been ordered, and I was offered a 6.5 rate. Can I still request a lower rate? So I guess they're just asking if they can ask for a lower rate.
Well, yes, of course.
Yeah, I guess it's kind of
anybody can request it. Yeah,
situational experience.
Absolutely, on a case-by-case basis. You can always request to see what we can do for you.
Cool. Sabra asks, she clarified and says a PPP is prepayment penalty. So
no, we have credit unions, and that's one of the good things about credit unions is that we do not have a prepayment penalty.
Gotcha.
Most banks do have a prepayment penalty, and they do it 5, 4, 3, 2, 1. So, and that's percentage of what the loan amount is. So if you were to refinance with them and you wanted to sell within a year, they're going to charge you 5% of your loan amount as a prepayment penalty. Credit unions are not allowed to charge prepayment penalties, so that you know, if somebody comes and makes you an offer you can't refuse,
Mhm.
then you don't have to worry about paying any penalties.
Gotcha. Okay, great. The next question here comes from Ty, and he says, estimated time frame. What is the estimated time frame for the cash out refi process, start to finish? So I guess how long does the application review and approval?
Yes, generally speaking, it's 4 to 6 weeks
Mhm.
from moment once we get a completed application, which means all the information that we require.
Okay.
It's generally 10 to 15 business days to give you a decision on your loan. And then once that is approved, then the process goes to the appraiser, title, getting all your other stuff together. And as long as you can get the appraiser and all your title stuff going, it's probably 5 to 6 weeks maximum.
Okay, gotcha. So again, that time frame you want to be able to factor into the Jumpstart loan of that year. So
Right.
yes, you have 12 months to complete construction, but really you need 11 or 10 and a half, right, to give you time to
Right.
refinance. So yeah, that's great. Sabra again asked, during appraisal, is PFCU expecting to see furniture in the apartments?
No.
No. Okay, gotcha. So they can be.
Yeah, a lot of times we have loans that we have approved that say the lease doesn't start to July 1st.
Mhm.
You know, a lot of our investors prefer that the appraiser can get out there before
Yep.
everybody puts their junk in there, right?
Yeah, sure. No, I get it.
So you can see the true beauty of the rehab, right?
Right. We have a question. Somebody says, is the appraisal free, or is the borrower paying for that? Does PFC?
The borrower pays for that. A single family appraisal costs $435. It's payable prior to ordering the appraisal.
Mhm.
If it's a 1 to 4 family, it's like $475.
Okay.
And then if it's mixed use or commercial, we have to get quotes on it. Once you get into mixed use and commercial,
Yeah.
the fees go way up for appraisals.
Makes sense. Gotcha. Okay, the next question here is from Keith, and he says, if you have no W-2 income, can you still do a PFCU refinance loan?
Well, you got to show some kind of income. I don't know where it's from, but
Yeah.
Generally speaking, if you're just depending on your real estate income and you have other debts,
Mhm.
it's probably going to be a challenge for you.
Okay, gotcha. Next question here comes from she's asking, does the property need to be in an LLC for a commercial refinance or cash out refinance? You mentioned no, it could be either personal or LLC.
Yep.
Okay. Next question, quite a bit here. We got a lot of questions. This is more questions we've had for most JUMPinars.
There you go.
Yeah, it's good. Somebody says, or Marcus says, is PFCU able to lend to different markets outside of Philadelphia or outside of PA even?
Yes, we could lend to the tri-state area.
Mhm.
But once again, you have to remember that to become a member, you have to live, work, worship, or do business in Pennsylvania. So we have borrowers that live in Pennsylvania, but they have properties in New Jersey or in Philadelphia, and they have properties in New Jersey. They can qualify, right? So as long as you meet that criteria.
Okay. Danielle is asking, can you get a HELOC or a home equity line of credit on a commercial investment property through PFCU? Is that something you guys offer, or would that be with a traditional bank?
On an investment property, that would be my question. But
okay, yeah, that would be for mainly home ownership, right? Yeah.
Well, generally speaking, if it's your first loan, we're going to say no. You can take the cash out and do with it what you want. We do have investors that provide substantial real estate, like with value, that we can give them a line of credit on. And then they use that line of credit to acquire, renovate, and then we'll do the permanent financing on it. But if you're generally speaking 100, 200,000, it generally doesn't work.
Okay. Another question here from Joyce, and she says, do you refinance for existing properties with current mortgages so money can be used to fix up the property? So I guess, do you have any construction loan financing? No.
We don't. We're looking into the construction financing now. We will only take a first position on
Okay.
the property.
Gotcha.
So we don't do any secondary mortgages.
Okay, gotcha. Just scanning through these questions here. Is there any Gene says, is there a seasoning time frame for the property to be rented, or having a renter is the only requirement? So we discussed before, right? 3 to 6 months could be
Yeah.
if it's your first
Yep.
project. Okay.
Yeah.
Is there any, if it is your first project, is there any, additional qualifications you could have that would alleviate that requirement? Or
Well, that's when they talked about putting up the 3 to 6 months rent in an escrow.
okay. Oh, okay, gotcha. Yeah. So you would kind of put that money
Right.
aside and then get the
Right.
refinance so that
Right.
okay, gotcha.
Right.
And then after that time frame expires, you get that money back. Gotcha.
Yep.
Okay, gotcha. Our next
As
question.
long as the loan's paid on time.
Right. Right. The next question here is from Hans, says, do most people pay off the loan to be debt-free before the 15-year period, or do they start another refi process to get out of the initial refi loan? Or if they do start another refi loan, are the terms the same as the initial one, or is it an ARM? I'm not sure what that means.
Adjustable rate mortgage.
Okay, adjustable rate.
So most people refinance for a couple reasons. One, the property has increased substantially in value, so they have a lot more equity than what we originally lent on.
Mhm.
They could be at a higher interest rate at that time,
Mhm.
and if the rates drop, you got a rate at 6.5, and now mortgage rates are at 4.
Mhm.
Then they might go, okay, now's a good time to refi,
Yeah.
right, to lower their interest rate. So yeah, there's a couple reasons, and we're open to all of them.
Okay, great. I'll end with one more question, and it's from Sabra again. She says, if you apply for the refinance under your LLC, does the loan report to your personal credit?
We do not report to your personal credit.
Okay, gotcha. I know it's a question a lot of people have. And since that was so quick, one more from Keith. He says, what documents are needed for a refi? Taxes, operating agreement, financial statement, etc. What other documentation might you require from a borrower?
Right. So what general would be, if it's an LLC, we need all your corporate documents, operating agreement, IRS tax ID, certificate of formation, right? 2 years personal tax returns, personal financial statement, and a copy of the existing lease or leases for the properties.
Okay.
That generally gets us started.
Okay, great. Sounds good. Well, that is all the questions we got, and I'm going to quickly pull up my closing slides. Dale, I just want to thank you one more time for joining us tonight. I thought this was really, really effective. And I know I have a better understanding of refinancing, so I'm sure these folks do as well. And really appreciate you taking the time to speak with us tonight.
Derek, thank you, and I hope I've been helpful.
All right, great. Dale, I will be sure to send out your contact information, so don't be shocked when you get a lot of emails from jump starters asking questions.
That's fine, and I'll send you some of the information you were asking for.
All right, that's wonderful. Thank you, Dale. And thanks everybody for those great questions. That was really excellent. I just want to quickly give a heads up about what's coming up with Jumpstart. We have another in-person JUMPinar on the 28th, and we're talking about deciding where to invest with 2 individuals from Select Commercial Advisors, Sam and Travis. So that'll be a great one. Don't miss that in person at our office. The next month, later in July, we're having another event, and this is brand new. It's called Jumpstart Think Tank, and it's going to be kind of a town hall, open forum style event where you'll have a chance to network and get some questions answered. What more details to be announced? We're still in the planning phase there. And then lastly, in August, we have commercial rehab financing, another virtual JUMPinar like this one on Zoom in the first week of August. And you can register for all those at jumpstartgermantown.com/events, and just go ahead and get them on your calendar. Lastly, I mentioned it earlier, but this Zoom recording will be up on our website at jumpstartgermantown.com/library. So you'll be able to access it tomorrow afternoon and send it to anybody who missed it, or for those who weren't here tonight, they'll be able to hop on and check out the recording. And that is all I got. So thank you so much, everybody. Appreciate you coming tonight, and I hope everybody is staying safe and healthy with the smoke outside. I haven't looked outside, but it's pretty scary. So stay inside, and thanks again for coming tonight. Have a good one.